Welcome to the Explainer. Hey, if you own or manage rental properties, you absolutely know the feeling. The gap between the money you should be making on paper and what actually hits your bank account, it can feel like a complete mystery sometimes. Well, today we're bridging that gap. Based on our source material, we're going to break down how getting a grip on your accounts receivable and automating your rent collection can literally transform how you run your business. Okay, let's dive into this. Here's our roadmap for today. We'll start with 1. The rent collection headache, 2. Gross potential rent explained, and 3. Calculating real vacancy losses. Then we'll pivot to the solutions with 4. Automating accounts receivable, 5. Eliminating the float time, and finally 6. Bulletproofing your rent roll. Section 1. The rent collection headache, why manual fails at scale. Before we even look at the math, we just have to address the elephant in the room. Are you still chasing down paper checks? Honestly, it's such a relatable pain point for so many property managers and landlords out there. When you first start out, collecting rent usually involves Venmo notifications, sending texts asking, hey, where's the rent? Or physically driving to the bank to deposit a check. Then you go home and manually update a rent paid column in your spreadsheet at midnight. It feels totally manageable. Until suddenly, it isn't. Now, here's a number from the research that literally made me pause. 59%. According to Gartner, 59% of accountants and bookkeepers admit to making several manual errors per month. Think about that for a second. If the literal professionals are making errors, the chances of our late-night spreadsheet updates being flawless are pretty slim. And a simple typo in a ledger or a misplaced check isn't just a minor oops, it can spark a legal dispute with a tenant or cause a reconciliation nightmare that takes hours to untangle. Manual data entry is a massive operational liability. Section 2. Gross potential rent explained, the theoretical ceiling. To understand why bulletproof rent collection is so absolutely crucial, we have to look at gross potential rent, or GPR. By definition, this is the maximum theoretical rental income a property could produce if every single unit were 100% occupied and paying full contractual rent. It's a gorgeous number. It's often the one listed on pro forma projections by sellers. But our sources highlight a catch. GPR is a perfect world scenario that almost never matches reality, mostly because silent killers of cash flow are always lurking. And that brings us to net operating income, or NOI. This is the true operating profit of a property. You calculate it by taking that gross income and subtracting your vacancy losses and operating expenses. Now, what's really interesting about this is how NOI becomes the single most important number in both commercial and residential real estate. It's the number that drives your capitalization rate, dictates your property valuations, and measures your actual real-world operational success before debt service even enters the picture. Section 3. Calculating real vacancy losses, the silent killer. So, how do we get from that theoretical GPR dream down to actual NOI? The data shows that experienced investors don't bank on a fantasy of 100% occupancy. No way. They always build a 5 to 10% vacancy assumption right into their numbers. In fact, the typical occupancy rate for residential properties in the U.S. hovers around 90%. So a 5 to 7% vacancy rate is actually considered optimal, signifying healthy demand while accounting for normal tenant turnover and maintenance periods. If you don't factor this healthy, normal turnover into your math, a property that looks cash flow positive on paper could end up losing money every single month. We can see exactly how this plays out using a real-world $279,000 property example. Say we start with a gross rental income of $23,400. Immediately, we have to subtract a 7% vacancy loss, which is $1,638. Then we subtract total operating cost, things like taxes, insurance, management, and utilities, totaling $10,914. That leaves us with a final net operating income of $12,486. This brilliantly illustrates how a 7% vacancy rate actively and materially reduces your bottom line. When we break down where that gross rental income actually goes, it's pretty revealing. Only 53% is your net operating income. That's the slice actually hitting your pocket or paying your mortgage. 40% is completely consumed by total operating costs, and there was that 7% slice just totally lost to vacancy. Seeing the proportions laid out like this really drives home how vital it is to protect every remaining percentage point of your collected rent. Section 4. Automating accounts receivable, the digital playbook. This brings us to the ultimate solution for those manual tracking issues we talked about earlier. There's a fantastic quote from our sources that perfectly sums up the challenge of growth. As you scale, simple manual habits become significant operational liabilities. What works perfectly for 1 or 2 units completely breaks down when you cross the threshold of 10 or 20. At that point, the administrative overhead of reconciling fragmented payments just becomes overwhelming. Automation goes from being a luxury to an absolute necessity. So, what does this look like? An automated accounts receivable playbook relies on 4 crucial steps. It starts with digital payments via ACH or card, which lets tenants set up recurring payments so you get paid faster. Next comes auto late fee assessment, which is huge because it completely removes human emotion and applies fees consistently the exact moment a grace period expires. From there, real-time ledger sync ensures that the second a payment clears, it's pulled securely into your dashboard without you lifting a finger. Finally, automated categorization distinguishes base rent from pet fees or deposits, keeping your taxable income perfectly accurate. Section 5. Eliminating the float time, protecting cash flow. All of this automation builds into another absolutely critical concept, float time. This is defined as the cash flow gap between the date rent is actually due and the moment those funds finally clear and become available in your bank account. Why does this matter? Because a high float time makes it dangerously hard to cover your own mortgages, property taxes, and operating expenses on time. If rent is due on the 1st, but a paper check doesn't clear until the 8th, well, you're the one floating that cash and carrying all the risk. Comparing these two methods makes the difference so obvious. Manual collection means waiting for the mail, physically depositing the check, and waiting for it to clear. That equals high float time. Automated ACH, on the other hand, means an instant digital transfer and an immediate bank sync. That equals 0 float time. So the crucial point is that forcing digital payments reduces those agonizing delays and keeps your cash flow entirely predictable. Section 6. Bulletproofing your rent roll, real-time reporting. When your rent collection is fully automated, it feeds perfectly into the essential audit-ready reports you need to actually run your business. You have the rent roll, which is the document lenders ask for first, giving you a forward-looking view of your occupancy health. There's the tenant ledger, providing a granular per-tenant transaction history, vital for winning eviction hearings or resolving disputes. You also get a real-time profit and loss statement to compare your actual income against deductible expenses, right alongside an accounts payable and arrears report that flags uncollected rent in 30, 60, and 90-day buckets so you can jump on it before it becomes bad debt. Our sources point out a massive warning sign to look out for on these reports. Watch the gap. Seriously, when your economic occupancy, which is the rent you're actually collecting, lags behind your physical occupancy, your portfolio is silently bleeding through concessions, write-offs, and chronic late payments. This is exactly why you need an automated system. You have to be able to instantly spot when a building that looks 100% full on paper isn't actually generating full cash flow in reality. Which leaves us with one final, pretty provocative question to ponder based on everything we've looked at today. Are your cash flow projections assuming a flawless 100% occupancy, or are you ready to let automation reveal the truth? It really might be time to ditch the spreadsheets, embrace financial clarity, and let the software do the heavy lifting for you. Thanks for joining me on this explainer.